Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
Welcome, everyone, to another episode of the Bigger Cash Flow podcast. Today, I have an exciting episode with the founder of OCG Properties. Matt Owens is with us today, and he has a company that specializes in equity and cash flowing real estate investments. He graduated from UC Santa Barbara with a bachelor's degree in economics with an emphasis in accounting. He earned a CPA license while performing audit and taxation engagements at various CPA firms and worked primarily on large real estate clients. He currently specializes in value-add cash-flowing residential and multifamily real estate investments, having purchased and flipped over 700 properties. Mathew currently works with investors in multiple ways to acquire real estate in high cash flow markets around the country, and he also helps investors develop various cash flow streams through syndications run by professional operators, promissory notes, and other real estate related assets. Many of his clients benefit from his knowledge of real estate taxation and due diligence, legal and investment structuring, and long-term investment planning and analysis. With that said, we'll welcome Mathew to the show. Welcome, Matt.
Thanks, man. I appreciate it.
Yeah. It's very exciting to have you on the show. You know, we connected a couple months back after I listened to one of your guest podcast episodes. We had a great conversation, and now here we are. I wanted to do an episode on private and hard money lending. A lot of our audience wants to scale their rental portfolio, and they sometimes run out of cash, right? Naturally. There's more deals that they may be generating than they have cash for. And a natural segue is to hard money lending. So you live and breathe this stuff. So why don't we start off by talking a little bit about yourself, giving us your background, and we'll get started from there.
Okay. Well, I'm a CPA. We basically flip houses, and the CPA skill sets and the math skill sets go perfectly into real estate because it's all about the numbers. You don't want to be emotional when you're investing, of course. And so, stick with those numbers consistently and you'll be okay for most of the time. But we go through and we flip consistently a little bit over 5 houses a month. We have done over 700 now. We do a lot of value add and multifamily projects. We do some short-term rentals. We lend out capital to different flippers in different markets around the country. We invest in long-term paper and short-term paper as well. In different ways. And then, we run a nonprofit organization called For Investors by Investors, where we just teach financial education and real estate education without the sales pitch or anything. And so through those methods, I have all the resources we need to do real estate. And, we focus a lot on creating value as we're buying these properties, as well as looking at how we can create value for other people through the lending aspect on what we do. And, it's a hard thing to understand the ways of raising capital for your deals and the different structures that you can do them within. You have the the traditional Fannie Mae, Freddie Mac loans, which is most people's initial option of what they go to buy rental property or real estate, or even on their flips sometimes. There's also a lot of local lenders and things like that you can go to. There's also professional long-term rental insurance or rental lenders as well that are outside of Fannie Mae and Freddie Mac. And then you have the private money lender as well, which is the professional lender that goes through and looks at a deal, and it might be at a higher interest rate, but it's strategic for a specific purpose where, a lot of times, you may not want to pay 10 to 12% on your money, except for a short period of time, of course, and you use that money to be able to rehab a property and refinance it, because those back-end lenders love it when you're bringing them finished product versus something that's need of renovation. They'll do those types of renovations as well in certain cases, but a lot of times they'll make you bring more money to the table, and there's different structures for each type of deal, right? So you also have the small multifamilies that you want to get financed to in a lot of ways for holds. So those are good strategies to use too for, finding your financing. So that's, I mean, we do a lot, all of this stuff across the board. It's a lot of fun. I feel like maybe I'm a little bit of a deal junkie, but at the same time, I'm looking for a lot of long-term multifamilies now, investing in notes quite a bit just so that I can start cash flowing. I have a 3-year-old and an 8-month-old. So I'm like, how do I retire and just spend more time with the kids, So
Yeah, yeah. Can you give our listeners a 10,000-foot overview in terms of what's the difference between private money and hard money lending? I know those terms are sometimes used interchangeably. Do you know the difference, and what are they?
So hard money lending is basically just a term that's been used to basically like describe a professional lender. Usually kind of comes with the coin of higher interest rates and things like that, or someone that's going to be there that might charge some points as well as a higher interest rate than not traditional, 5.5 to 6.5% interest rates like a bank would give, but more like the 10 to 12% rates or something along those lines, when someone's going to underwrite the property for you, do all the workload involved in and ordering the appraisal, going through and doing the underwriting in-house. They're going to make sure that they're comfortable with the loan and make sure that you have the right contractors and people in place to get the deal done. And they're good to go to because they can stop you from doing a bad deal, right? They can be the ones that basically, put their foot in and say, look, you're going to put this much capital in, but we'll bring the rest of the table for you and help you get this deal done. And we can close in a week for you in all cash with no problems. And as long as you bring whatever X amount of money to the deal, usually they want to have you have some skin in the game in that deal, of course, usually around 10 to 15%. But they also are going to limit the margin and tell you, hey, there's not enough margin in this deal. Don't do it on a flip. Or, hey, what is your exit strategy for this? And they can be creative for you. That's kind of more of a hard money lender, someone that's going to be there analyzing the deal with you, being there to close in a week, or 2 weeks cash, being there to tell you when you're doing a bad deal and you shouldn't do it, or if you're messing up on your construction costs or something like that, because they have a lot of experience doing that. That's what we do when we're lending to these different flippers in different markets. I've saved somebody $40,000 because they were going to go through and do a wholesale deal, and their buyer backed out the day of closing, and I came in and closed the same day and underwrote the deal myself and saved him $40,000, and he was like the happiest person on the planet. And I even go and review some of his deals and say, hey, you're leaving money on the table on your analysis here. If you do this and this, you'll be able to get more pricing out of it. I'll underwrite it at your value, but realize you're leaving 10 grand on the table or something. And they add those values in those types of ways. A private lender, on the other hand, is more like the non-professional investor that's going to lend you the money, typically very passively at 6 to 8% interest rates, sometimes 10, depending on their sophistication and how much capital they have. Also depends on what risk they're willing to take. Usually, if someone's willing to give 10%, maybe they, fund all the deal, or they fund a bigger percentage of that deal as well. Or if they're, I raise capital a lot of times at the 6 to 8% range, depending on the situation and from my private investors. But in the beginning, it was much higher before I had the right relationships with a lot of private individuals and private investors. And so now I will borrow at their rates and go lend it out at higher rates and make an interest rate spread because I have so much private investor capital available in different ways. I'm forming a fund to do some of this stuff, which I won't talk about now, but there's a different way of raising capital and things like that, and a bunch of different types of structures to do these types of opportunities. And so the private lender is more, you're going to assign them a deed of trust and give them a promissory note, make sure they have their collateral in place, because this is people's lives, the hours of their life that they've saved for this money. And so if you're able to make sure they're protected and describe to them how they're protected, and they're going to be very passive usually in this case, and you're just basically borrowing their money to go buy a property or use it to basically as a loan or something like that on that side, or joint venture or something along those lines. But typically you're looking at the non-professional that isn't doing a lot of work, that you're providing all the documentation of, here's the comps, here's the the loan to value, here's what I see as far as the rehab on the property, and and helping them understand that. They're the non-professional.
Exactly.
But they may not close either. They may be scared and say, no, I don't want to give you that $50,000. I'm too nervous. Or, hey, something came up and I got to walk. So, that's why the professionals a lot of times go to the hard money lenders or the professional lenders involved, the professional flippers, because they know they need to have them there to rely on.
That's a really good summary. And, the way that I define it is, with private lenders, it's going to be your mom and pops, like your parents, your family and friends, maybe your coworkers who trust you and invest in you. And their main criteria is, do they have a relationship with you? And the trust is there, right? They might not necessarily underwrite the deal to the extent a hard money lender might. So the pros that I see with a hard money lender is, just like Matt said, you do have an objective third party. It's in their interest to make sure that you're investing in a good deal, because that's their collateral for their money that they're investing in with you, right? So just like how I like, investors not buying all cash because there is that appraisal contingency, right? You might think you're getting a slam dunk deal, but later on you try to get it appraised and it doesn't even appraise for 80% of what you paid for in cash, right? So there is a discrepancy there. But with hard money lenders, they might underwrite the deal and say, hey, you need to buy it for $10,000 less to make the numbers work, or you need to do this, or you should do that, or this is not a good area that I would invest in, because they might, professionally have 50 other loans in that same, for example, Kansas City market that you're investing in, and they might see the trends for the past 12 months. So those are some pros and cons and nuances that I see, and I think that was a great summary.
I think it's important too to note that when you're dealing with private investors, it's really important, even though they're doing it based off of trust. It's really important to back yourself up and back your numbers up and show them how they're protected so they're educated, because when they're not educated, that's when you get into trouble, or they freak out on you not understanding something, or I've fired private investors before because I got yelled at for them getting paid off because they didn't want their money back yet, and I and they signed a release and everything. So you want to watch out for crazy people too, because when you're dealing with people's money, all of a sudden their mentality and changes, and so you want to know who you're dealing with. We have some clients that if that payment is not in their inbox by the first of the month, or in their bank account cleared, they're calling you to say, hey, where's my payment? I just wanted to know where it is. And then other ones don't even realize that you've ever even made payments, or not even ever checking, even though you're making the payments and everything. And so you want to understand who you're doing business with and people's personalities and what they expect, and make sure that communication is there, much more than the professional lender, because they already know what they're doing. It's when someone doesn't know what they're doing that becomes an issue, or can become an issue. There's also lending law issues and things like that you want to be careful of, depending on where you're borrowing the money, what properties, if you're doing it against California properties or different markets in the country, or if you're borrowing money from people in certain states, and you want to be careful of interstate laws and things like that. And so it's important when you're borrowing money to make sure that you talk to a lending attorney specifically about that, to especially when you're dealing with private investors and things like that.
More recently, the 10-year treasury, it kind of dipped and there was an inversion. And, typically when that happens, based on my understanding, is that banks might not be as interested in lending out their money because the spread that they're making is much, thinner or non-existent versus a short term. So, in that situation, how does that impact private lending and hard money lending? Does that also close their pockets, or are they more open to lend out during those times?
I think a lot of professional lenders will. So one, I don't think it affects too much of the individual private investor. So because it's a matter of what they're getting elsewhere and the trust that we talked about, right? So and what's working for them for cash flow purposes, and based on their personal situation. So I don't think it, if they can't buy a new house, it might affect them that way, where they're getting bumped on their rate and they need more savings or something like that, and they can't lend or invest as much. But I don't see it, other than economically harming them, any major change to their rates and terms and things like that of what you can sell, right? The professional lenders, sometimes they are private investors, and it's the same situation where they're using private money, but a lot of times they're also utilizing, lines of credit and bank lines and things like that, which may dry up in certain ways if there's an inverted interest rate where they're not making money on their loans. If it goes negative, they could basically just like not lend at all, and we could have a whole another liquidity crisis like last time, but for a different reason, right?
Mm-hmm.
So from that standpoint, I think it may, affect things, but I don't think it may reduce the supply of capital, and people may want to be a little bit less aggressive and only lend on the stuff that is valuable to them, and maybe their rates get bumped a little bit if they don't have that. Now they got to go to private money instead, so instead of bank money that can be a lot cheaper sometimes. So we have lines of credit with the bank that you can get them as low as 5.5, you can get them as high as 12. It just depends on your credit and your business credit and things like that. So, and a lot of the professional lenders, they sell their paper off automatically, to other people, and they use it. They have a line of credit, and they also have their own capital, and they recycle it and then sell the paper off too. So it depends on what those people are buying it for, as well. But usually at the hard money rates, it's a different market.
So let's kind of dive into some of the things that you look for when you're underwriting a deal. So let's just say I'm an investor investing in Kansas City, and I'm looking at a $100,000 home that I'm buying from a wholesaler for like $60,000. I want to put like $20,000 worth of work in it. If I bring you this deal, what are some of the things that you're looking at, something that I should be aware of as a borrower so that I can better prepare myself?
So the first thing to put yourself in the right position is to have cash reserves, to put some capital. So talking about you as the borrower before the property specifically, right?
Yep.
From a borrower perspective, any kind of cash reserves that shows that you can put the money into the deal, not just cash reserves for the deal and maybe the excess renovation costs or excess purchase price over what the lender will fund, but some reserves for you personally, so that way they know that you're not going to be bleeding and have no money if something else goes wrong. It's really looking at, is this person financially viable? Can they afford to be doing this? If something happens and $10,000 of rehab overage comes in, or a contractor steals from them, can they bail themselves out, or am I going to have to come in and bail them out? Out of the situation, right? So that's, one thing is looking at the financial strength of the borrower and putting an understanding of, what reserves do they have, and are they prepared for this? Then it's also looking at, what are their skill sets? How do they present the information to me? Do they know what their numbers are, and are they coming up with real numbers, or are they forgetting closing costs and interest costs and things like that, to understand if they know what they're doing on the flip side, and getting a gauge for their experience of, have they done any other flips? Who's their contractors and their team members? Who's their realtors involved and their closing attorneys? And do they know all that, or are they just not sure? What about their insurance? And, asking question after question. Like, we basically have a questionnaire that they fill out, and it makes them think about everything, so that we can have them fill it all out, and then we get all of our information. But in reality, it's a matter of, hey, what if you were lending somebody money? What are the concerns that you would have when you're, can this person pay me back? And is my collateral good enough, to pay me back? And so when it's an asset-based loan, you're looking at the trust of the person first, because even if you can foreclose, you don't want to have to, and you don't want to deal with it. The lenders just want to dump the properties and, on that side, and you don't want non-performing paper walking around. So I would say that, from a borrower perspective, understanding that aspect of things and the teams involved and the financial strength is super important. And then on the property side, it's, did they comp out the property right in the first place on an after repaired market value? Is there provable comps that show that? Because an appraiser is going to look in the last 6 months within a half a mile of the property first. And if they don't see that, then you're going to have an appraisal problem. And you want to understand you're comparing apples to apples. So, you want to understand, what is the renovation going to be? Is that $20,000 renovation that you just said? Is that get it to top-notch level, or is that a notch below that where, you know, there might be a $10,000 price difference or whatever that price difference is depending on the market, you know, that you're dealing with. I said 10,000 because it's Kansas City, for example. So, looking at, you know, that pricing difference on, are you comparing apples to apples? Does that borrower have previous pictures of what their renovations look like? And do their renovations reflect that? So you're looking at the before pictures and then looking at their renovation bid and saying, yes, does this make sense on an interior, exterior, and, you know, all other mechanical systems basis, right? To say, you know, this is all from an underwriting standpoint. What does that look like? And as the borrower, you know, reflected what an accurate bid would look like based on the underwriter's experience, or, you know, or based on real numbers. And, you know, $20,000 is a thin rehab a lot of the times. It doesn't necessarily mean major systems, you know, and a lot of times it can be $40,000 for a renovation to get things to the right level or more, especially if you're dealing with a higher square footage house and higher end materials and stuff like that. So understanding the borrower's knowledge of those and how they came up with their renovation estimates, I think, is very, very key. So, you know, and then from the lender perspective, I'm looking at if the value is $100,000, and, you know, what should they be into it for to make a minimum of a 10% margin, or 10 grand or 15 grand on that sale. And then let's back up to minus their rehab, and what are they buying it for? You know, and then minus any other costs as well involved, of course, too, to see what those numbers really are, and are they buying a decent deal? And then I'll determine, you know, based on my experience with them and things like that, should I go to what loan to value am I comfortable with? How much of the renovation should I put in? And how much of construction holds or interest holds should I have on that project? And does the investor have the capital to handle that? So we have a whole spreadsheet. We say, fill out the spreadsheet, show us what your profit is and how much money you want to put into the deal. and then, you know, if they can't do that, then we might have a problem and not want to lend to them, because if they can't understand that piece, maybe they shouldn't be flipping, you know? So, and sometimes it's an Excel issue, because you got the contractor mindset guy that's on the ground working with his hands all the time, and they're not the numbers guys, but they know the numbers on a project generally, but they're just not good at putting it in the right format. And so, you know, we'll work with people like that sometimes to help them with that process if we see they have a massive amount of experience otherwise, you know, so, or a different team member involved that can help them with that.
It sometimes messes me up how, like, you know, investors look at HGTV flip shows and they're like, you know, $300,000 sale price. You bought it for 200 and rehabbed it for 50. So my profit is $50,000. Let's find another flip. And you're like, wait a minute, what about selling costs, holding costs, you know, utilities, all that good stuff.
It's amazing. And then you got the guys that you see in Vegas a few times where they're like, yeah, we're going to get this thing done in a week and listed and sold on the same weekend. And they're acting like it's all like drama. And you're like, okay, this is amazingly ridiculous. But yeah. So,
taking a step back to the borrower's perspective, sometimes borrowers might go to private or hard money lending just because they don't qualify for Fannie Mae underwriting guidelines. So if there is an investor who have done, you know, a dozen flips, but, you know, their credit is shot, is it a case-by-case basis? Would you look more on the deal that they have in hand, or is their income and credit still, you know, reasonably important factor?
So their cash reserves is more important than anything else. And their experience and the asset gives more weight. But if their credit was shot, you know, we still do a background check and a credit check. And I want to see, is it because he has a bunch of credit card balances that came up over time, you know, or that got defaulted and are behind a lot of times, or a bunch of missed payments and things like that, versus medical debt or some other reasoning, that, you know, the market crash or something like that occurred. You know, I have that excuse myself in the beginning. So yeah, my credit's really high now, but you know, when you take a market hit, I quit my CPA firm job in 2006. So I was a real estate genius for a year before I got punched in the face. So it happens consistently, and you know, it will happen again. And that doesn't mean that people aren't viable if they understand what they're doing. You actually learn a lot. And if someone just declared bankruptcy or something because of medical debt or something, and I know that they have no debt anymore, it actually makes them a little bit cleaner. if I understand the reasoning behind it, or, you know, if there's a viable reason behind it, you know. So, but everybody goes through, you know, turmoil and stuff like that. It really comes down to the asset first. And if I believe this person is going to pay me back and not screw me over, you know, so.
Okay, I love that. So what is the process like? Because you mentioned earlier, even with a private lender, you need to protect the lender and yourself through educating them, which is really important. And also with a first deed of trust and a promissory note. Can you tell our listeners just at a high level, what is a, you know, first position lien and what's a promissory note?
Okay, so the promissory note is the contract that governs, that has the interest rate, it has the term in there, it has the collateral listed in there, it has the default interest rates, it has all the terms of that contract. That's the promise to pay, and that's a legal document, whether it is, where someone defaults on that document, whether you have a deed of trust or secured against the property or not, you could sue somebody for that, for not paying you under that contract if you let someone borrow money. Whether you have collateral rights or not. The deed of trust or the mortgage in certain states, is what gives you the collateral interest in the property that secures your money by the property, and usually recorded at the county recorder's office, to protect that investor's interest in that property in case of default. Okay, so if there's a default, the investor that lent the money can go and foreclose on that property and hire a closing attorney or a foreclosure attorney to foreclose on that property, if they needed to, or if there was a default on that promissory note under that contract. So it's just your form of collateral, and the promissory note is your actual contract that you put in place. Now, the promissory note needs to be reviewed by attorneys, and same thing with the deed of trust or mortgage in each state that you're doing business in, because you have different laws in each state, and you want to be very careful about, you know, the legality of what you're doing. For example, in Tennessee, if you are lending above the usurious rate, which is 9.5%, you could get in trouble legally. But if your promissory notes are governed in a different state under different state law, then the Tennessee usury doesn't apply and you're fine. So, you know, it's different little specific things like that that you want to be very careful of when you're lending, to not do too much, you know. So, and make sure you're compliant with the different laws and stuff like that. So the education piece of that is important.
Yeah. So, you know, just to recap in layman terms, promissory note is basically a promise to pay this individual, like Matt in this case. And to clarify for our listeners, as the borrower or the purchaser of that property, you still hold title. But the lender, in this case, Matt, he would have first position, like first dibs, for lack of a better word, if anything were to go south. If I have to sell it, you know, if I have a loan for it for $40,000 and I sell it for 60, before I see any of that profit, correct me if I'm wrong, Matt, 40 of that amount goes to you to pay off any first lien debt.
Correct. And usually, if you don't have a due on sale clause in the promissory note, someone could sell the property for 60 and take back financing and do seller financing or something and wrap around your current loan, and stuff like that. You would still be obligated under that loan as well. And, you know, we usually have a personal guarantee involved. We have a assignment of rents and leases, which basically says that if you rent the property and don't pay us, we have the right to collect the rents directly, and that gets recorded as well. You know, especially in these cash flow markets, that you're buying rentals and rehabbing them to get them rented afterwards and then refinancing them. So, you know, all of these things are great strategies. And there's first, like you said, first position is just being secured against the property and the first person on that property. You can have a second, a third, a fourth, a fifth, you know, usually like a second position loan, that means it's subordinate to the first. So if that first doesn't get paid, then the first can foreclose and the second can be wiped out. So you want to be very careful there. If you're ever doing second position loans, you want to know that that first is getting paid and have proof that that first is getting paid, and understand the contract terms and be able to pay off that first if you had to be able to take that property back if they default. So, and you can foreclose in your contract in the second position loan, you can put in there that if the first is in default, you have the right to foreclose on the property when being in second position too, even though they didn't default on your loan. It's considered a default if they default on the first. So that way it protects you in second position. So, and you can usually make a little bit higher interest rates when you're in second position, but at the same time, you're looking at that additional risk, but you can mitigate it a lot of the ways by making sure that the first is getting paid and understanding those contracts when they're due and having the power to pay them off too, if something happens. Because, if you need to go pay them 300 grand or something, make sure you have somebody else that can help you with that if you don't have the money in case something happens, so you don't lose your money.
This is all great stuff. And you don't see this type of nuanced knowledge out there in the internet because, this is based on real experience, right? I've actually had an investor who thought he was in first, but lo and behold, he found out he was in second. And, he was charging him 7-8% interest, where the amount of interest he was making was nowhere near compared to the risk that he was taking, basically, because I was looking at the deal and the margins were so thin that there was no way this guy was going to get paid out, even if he sold for what he thought the property was going to sell for, because there's other costs involved. So he should have at least get some points in the beginning or charge a higher interest rate or do something to protect his interest as a second, but he just thought he was in a first. So from a lender's perspective, there's lots of, mom and pops thinking, hey, they went to a self-directed IRA seminar and okay, now I can start private lending in these deals, and they make these mistakes. Just like you said, they might not put a due on sale clause, or they might not do their proper due diligence. So I think all of this stuff is really good stuff.
Yeah, it's crazy how often that happens. And you as an investor, if you're borrowing funds from private investors, you almost have a fiduciary duty to explain some of these things and share with them, how you've came up with market value, what the numbers of the deal are, so they can see your profitability. So you can teach them, because if they do it wrong, they're going to do it with, even if you're honest and everything's fine and everything on your side, they do it with somebody else thinking they have experience now. And then that person could screw them, and then they realize that, hey, we've been doing it wrong the whole time, and then they're mad, or whatever it is. You just want to make sure that they understand so that they don't lose their money somewhere else.
Can investors borrow in their own name, or can they invest in an LLC?
So they can borrow in either. So usually it doesn't matter when you're dealing with Fannie Freddie money. Then you're dealing with. You usually want to do it in your own name. They won't normally do it to an LLC. But when you're dealing with hard money, it doesn't really matter. I'd actually prefer to be an entity doing hard money, because you get away from them telling you they're not going to use it as their primary residence and then lying to you in that kind of situation, and that becomes different legally from the lending perspective, lending to homeowners versus lending for commercial purposes for a flip that's a business use. So there's a lot more regulations for homeowners, basically.
Gotcha. Okay. And I know on the show, we kind of talked a couple times about interest rates and how interest rates are rising and how hard money and private lending might be a couple points above the conventional Fannie Mae loans. However, one of the things that, my mentor told me was we're so stuck on interest rates. But as savvy investors, I'm sure you can relate to this, is we should be focusing on the cost of borrowing, right? Not the interest rate. So can you talk to our investors about how they can, from a mindset perspective, get over that hurdle and focus on the value that it's actually bringing?
Basically what you're able to do with hard money or more expensive money is close super fast. And typically when you can close super fast, you can get a discount on the property that's far greater than the cost difference. So, for example, if you're looking at, a 6% difference, if you can borrow from 6% from a bank and, you have a hard money lender that's going to charge you 12 for an entire year period of time, and you think, hey, I need to buy this property and renovate it, and it's going to cost me a year, right? On a $100,000 loan, that's $6,000 difference, right? So can you go through and get a $6,000 discount on a property by buying it really fast and closing 2 weeks cash, $10,000 earnest money deposit or more, and being there immediately to close escrow? Can you get more than $6,000 in your pricing for utilizing that. Plus, you probably wouldn't be able to close that quickly in any of the other traditional loans anyways. So you're losing out on a deal where, you know, maybe you're buying something on the open market that's worth 100, and you're probably going to be in that thing for 75 to 85 or something like that if you're buying a property that needs renovation and you can use private money and then refinance it afterwards. You know, so that is the real value. You're creating much more value by being able to take it down faster and do those. And then there's also people that use their own money, right? They'll go through and say, hey, you know what, I'm going to go buy a property and I'm going to use my own money, so I don't have to deal with interest. I don't want to deal with any of it, not even bank money. And what happens is, if they're marketing for good deals and they're constantly trying to find good deals or analyzing them, they run into a situation where they run out of money. And so then they're going, great, you know, I got 2 deals that are fully funded by me, but I got 3 more that I could close and make 40 grand on, or 10 or 20 grand on. Is it worth it to pay the hard money lender to refinance what you have and pull some capital out, or take down the other deals you might make a little bit less profit, but it's really not that big of a deal, the difference. And if you're talking about like a 6-month period of a rehab, you know, that $6,000 difference on $100,000 turns into 3. It's not that much difference if you're making 15 to 20 on a flip. It makes a lot of sense to just use that money and go for it.
I think it's a mindset shift, focusing not on the cost, but the upside and what you can do with that money.
I agree 100%. It's amazing what you can do with other people's money. I mean, we make $30,000 to $50,000 a month lending other people's money out consistently. And we put our own money in too to protect our investors' interest, and we do all the underwriting ourselves and make spreads on the capital. But, you know, there's so many people that don't know what to do with their money, and they need a reliable source that's going to be honest with them, protect them. And if you know how to do that, it's amazing what you can do. Buying apartment buildings, you know, doing all kinds of stuff. We just finished and sold a 19-unit building that we bought for 149 grand, and then we went and rehabbed, and we were into it for about 950. And we had private investors put in 300 grand, and the bank come with the rest. I didn't put any money in myself, and we went and sold it for $1.85 million and split the profits, you know, on it, and we just killed it on that deal. You know, so you're using other people's money. Yeah, did I look at it and say, dang, I just gave up a big chunk of money to these guys that put up some money? Yeah, of course. I didn't know it was going to be a home run, and it was also a $650,000 rehab. You know, that's a scary thing, you know, and so looking back at it, you know, yeah, you can be upset and say, yeah, I paid a bunch of money for the interest, but I also made like 400 grand, you know, so it was a great win for me on that side, you know. But and the same thing with, we did a 30 unit the same way. We're working on a 15 unit that we're turning into an 18 unit right now in Little Rock. We've done a lot of these smaller multis with all other people's money. In the beginning, I didn't know anybody with $30,000 in their bank account. I'm like, my friends are broke. I don't have any rich friends. Let me go network. And so I started going to networking events. The way you raise this private capital is you go to networking events consistently. I was going to 4 a week, every single week for like a couple of years, consistently meeting people and going to the same ones every month, because you start to get to know people that are reoccurring people. And those are the people that are getting value out of that meeting because they're doing things in real estate. They're not the looky-loos that are just kind of like, hey, I'm interested, but I don't know what to do yet, you know? So, it's great to get educated first, but taking action is obviously key, right? So
I love it. I love it. I'm going to quote this when you said, you know, I went to meetups consistently for years, right? Until you started to see those results, because, you know, it reminds me of the quote, I think it's by Jim Rohn, where he says, life doesn't get better by chance. It gets better by change, right? So you have to take that action, because if you just sit on this knowledge, it's not going to do you any good. So you just have to go out and take massive action. And I think you just exemplify that. So that's awesome.
I think the best way to find these deals in the first place is constantly be reviewing deals over and over and over again, and just get to know how to review a deal in 10 minutes until you're really, really good at it and know those numbers. And that's when you can start to really make offer after offer. And the more offers you make, the more deals you're going to get.
No, I love that, because, you know, I just came across Kansas City properties where I underwrote a deal in this neighborhood, and it didn't work for me, the numbers, but, you know, 2 days later, there was another property like 2 doors down that was like 15K off. I'm like, dude, that's a deal.
Yeah, that works. Yeah, all of a sudden it's like then you know the area and now you can do it even faster.
So before we, sign off, can you kind of share with our listeners how they can get in contact with you?
Yeah, we provide houses and multifamilies and do joint ventures with investors as well on actual property. We lend capital out and work with private investors if they want to lend capital and work and be a lender. We go lend it out and do all the work involved as well, and work with investors in that way. And then we also do are always trying to lend capital out on the borrower side as well as as long as the numbers are working and everything, of course. And then we also go through and do different syndicated investments and things like that, and are involved in that. And I just help people with their financial situation, and a lot of people come to me to help analyze their deals. And things like that as well. They can reach me at invest@ocgproperties.com, and it's the best way. If you call me, I won't answer the phone, so call or email, so it'll work. But invest@ocgproperties.com is the best place to get a hold of me.
Awesome. And you have a really awesome meetup. Did you want to share with our listeners as well? Where can they go to this meetup?
Yeah, so the meetups are for investors by investors, and we have chapters throughout Southern California, and they're all on meetup.com. If you type in FIBI and take the distance piece away so that you can go unlimited distance, you'll see all of our chapters throughout Southern California. I run the Long Beach Cerritos chapter, and then I help run the South Bay chapter as well. We have one in Orange County, we have one in Pasadena, we have one in Culver City. We have a couple of more, and one in the Inland Empire, one in Palm Springs area. So we have about a number of chapters and about 25,000 members, and it's all education based. We just teach. So meetup.com, FIBI is how you find that, or you can go to forinvestorsbyinvestors.com.
Fantastic. Well, Matt, I want to definitely thank you for coming on the show. We're definitely going to have you back and pick your brain on, if the market changes or, what's new in your business. If you guys thought that was helpful, please do us a huge favor and leave us a review on iTunes. We'll see you guys right back here next week for another exciting episode of the Bigger Cash Flow Podcast. Thank you for listening to the Bigger Cash Flow Podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.